Okay, we've received your investment analysis report, which is centered on a really interesting bull case for AMC stock. In short, the material argues that Wall Street is fixated on debt and net loss, while completely ignoring the record $12.25 revenue per patron, which you see as the key to growth. Let's dig right in. So a central theme here seems to be this contrast between the perceived weakness, that big debt number, and this very real operational strength. I mean, the record 1225 RPP and that 54% jump in contribution margin per patron. That's a huge number.
It's laid out very clearly. And building on that, my first thought is this. To enhance the robustness of the bull thesis, the analysis must more explicitly quantify how the record revenue per patron directly mitigates the primary bear concern, which is the debt load and the net loss. Right now, the analysis sort of establishes two parallel ideas. Debt is bad, and efficiency, that 1225 RPP, is good.
But it doesn't really connect them?
Exactly. It doesn't demonstrate the operational bridge. The report calls AMC a cash printing machine, which is a great phrase, but the financial leverage needed to overcome something specific like debt refinancing costs is just left as an assumption. It's not a calculation.
I see. So the reader is kind of asked to take a leap of faith that the operational strength is big enough to solve the financial problem.
Yes, and if the multi-billion-dollar debt is the number one thing scaring people away, the solution has to be shown to directly attack that fear.
So the weakness is a failure of quantification.
Precisely. So for an improvement, I'd suggest integrating that high-efficiency metric, the RPP, and especially that 54% margin increase, into a structured break-even or, say, a debt service coverage analysis. We need to physically connect the operational success to the financial health.
But is that even possible? The debt is massive. Even with a record RPP, doesn't it need almost impossibly high attendance just to cover the quarterly interest?
If that's the case, we have to tackle that head on, right? That is the critical point to confront. And that is why that 54% jump in contribution margin per patron is actually the most powerful tool you have. I mean, that margin is the pure operational profit from each customer. That increase is tangible proof of internal controls that management has put in place.
Okay, so that's the real lever. You're saying we should use that to make the argument more concrete.
Absolutely. For example, introduce a specific scenario. Show the reduction in the quarterly net loss with just a conservative 10% increase in attendance using that record RPP multiplier.
That would transform an abstract number into a measurable solution. You'd see the actual net income improvement.
And to build on that, you could even develop a simple model, detail exactly how many patrons at that current record rate are needed to generate enough contribution margin to offset one quarterly debt interest payment. It gives your reader a tangible hurdle, and it proves the RPP isn't just a vanity metric, it's a debt slayer.
Okay, that definitely strengthens the financial justification. So moving on to the future outlook, the material makes a strong case for growth with this coiled spring setup, but it relies very heavily on the idea that box office volume will come roaring back, specifically in 2026. That's the primary catalyst.
It is, and while the coiled spring thesis is compelling, it relies on an external assumption, that 2026 recovery, that, well, it lacks supporting evidence within the analysis itself, and that creates a potential point of fragility.
Right. If you're going to name a specific year as the catalyst, you really have to justify why that year.
Precisely. The weakness is that the statement, the fuel is coming, referring to better movies in 2026, is just asserted. It's not supported. And if that movie slate underperforms, and we all know how volatile Hollywood can be, the whole multiplier effect gets delayed or worse, neutralized. It leaves the stock pretty vulnerable.
I get needing a clear catalyst, but tying the whole thing to an external movie schedule feels risky when the report's core strength is all about internal efficiency.
That observation is key. So the suggestion for improvement is really twofold. First, you have to bolster the credibility of that 2026 projection with some verifiable external data. And second, diversify the catalyst. Show how that high RPP can drive growth even if the Hollywood slate disappoints.
So for external data, you're talking about citing analyst consensus on the box office? Or maybe known production schedules from major studios that show why 26 is a big year?
Yes, instead of just stating it as a fact. But let's push on that diversification point, because that's where this gets really interesting. The analysis has already established this unprecedented ability to extract revenue per customer. So let's explore how that's driven internally.
That's a great point. I mean, where is that 1225 metric coming from? Is it just ticket inflation, or is it fundamentally new revenue streams? Premium seating, alcohol, better concessions.
It has to be the latter, and that internal control is the key. If management initiatives are driving RPP success, then you can explore how that high-efficiency model could be applied to non-movie events. Think concerts, esports, special theatrical releases that aren't dependent on the big studio calendar.
So you're creating a secondary powerful catalyst. It sort of decouples the investment thesis from the volatility of the box office.
It strengthens the report significantly. It shows multiple paths to leveraging that record-breaking efficiency.
Okay, we've covered the math and the timeline. Let's talk about the vibe of the report. The material uses some very high-energy language. Terms like Wall Street panic, victory lapping, calling the company a cash-printing machine. It definitely creates urgency.
It does, and it's engaging. But while that high-energy tone helps frame the narrative, the use of overly dramatic, emotionally charged financial terms risks undermining the credibility of the deep, specific metric analysis you've done. The weakness is that the real strength of this analysis lies in those hard numbers, the 1225 RPP, the 54% margin increase. That's the story, and that hard data gets diluted when it's framed with hyperbole like secret multiplier or that the revenue explodes upward. A sophisticated investor might see that and question the objectivity of the whole thing.
I've seen that happen. A really strong analysis gets dismissed just because the author falls in love with their own rhetoric. It's a fine line between compelling and credible.
Exactly. The numbers themselves should provide the drama. So the suggestion is to keep the compelling narrative, but swap out the most exaggerated phrases for more precise financial language. Let the operating leverage speak for itself.
So, for example, instead of saying revenue explodes upwards,
You could use precise terminology, like saying the company demonstrates significant operating leverage. Using that specific term, operating leverage, tells a professional investor that you know exactly how efficiently fixed costs scale with attendance. It's honestly more powerful.
okay, and similarly, instead of a dramatic claim like the narrative that nobody goes to the movies is dead,
Replace it with a quantifiable comparison. State that the 1225 RRPP signifies a, say, 20% increase over the previous all-time peak. Emphasize the tangible difference, not a general statement on market sentiment.
that calibration is pretty critical.
It is. And one last thing on that, the $7.74 food and beverage metric. Frame it not just as a high number, but as a specific indicator of improved inventory management and pricing power. That level of detail just reinforces credibility.
That was a deep exploration of the analysis, really focusing on this metric that Wall Street seems to be ignoring. That $12.25 revenue per patron.
Yeah, the core strengths of the analysis are undeniable. You found the right metric and built a clear thesis around it. To make this work truly bulletproof,